In the latest quarter, the six largest banks in Canada have set aside a staggering $4.3 billion to prepare for possible bad loans. This amount is nearly double what they reserved during the same period last year, significantly higher in previous quarters. The banks are taking proactive steps, setting aside more funds than ever before. Experts indicate that a significant concern revolves around home ownership interest rates have surged rapidly and dramatically, a situation that has never been seen before, heightening risk for borrowers. Although mortgage rates are currently elevated, they have recently seen a decline, prompting questions about what banks might anticipate that average person does not. Despite the rising interest rates, Canadians have managed to keep up with their mortgage payments relatively well. In the first quarter of this year, only 0.19% of mortgages were over 3 months delinquent. While this is a slight increase from last year, it remains manageable given the aggressive interest rate hikes and high inflation we've experienced. Interestingly, most Canadians with mortgages have not yet felt the impact of rising interest rates on their monthly payments. This is largely because over half of these mortgages are fixed rates. Homeowners will only face higher payments when their mortgages contracts come up for renewal. Notably, more than three quarters of all Canadian mortgages are set to renew between now and end of 2026, creating a significant wave of renewals in a short time frame. A few years ago, the market was ripe for the home purchase. From 2019 to early 2022, interest rates were the historic lows, allowing many people to take out larger loans and buy homes they could not have afforded otherwise. This period was dubbed the real estate Christmas due to the unprecedented volume of real estate transactions. However, those secure mortgages during this period of time will soon face rising payments. The extent of these increases will depend on when they renew, occurs whether the Bank of Canada can implement cut rate. Recently, the Bank of Canada lowered the benchmark interest rate by a quarter percentage point, making a first cut since March 2020. While this is a positive step, it will take time and effects to be felt wildly. Homeowners currently paying under 3% interest will see their payments rise significantly upon renewal. For example, consider a young couple in Ontario who purchased their average priced home in 2019 for $639,190, making a standard 20% down payment. This results in mortgage of approximately $500,000 with a 5-year fixed rate at 2.9%. Their monthly payment has been around $2,367. However, as this renew in 2024, a current rate of 6%, the payment could jump to roughly $3,075, an increase of about $700 per month. You might be asking about those with variable rates mortgages. These loans fluctuate the prime rate, so they have already been adjusting their budgets. However, a significant concern lies with the variable rate mortgages who have fixed monthly payments. This represents a large portion of variable rate mortgage borrowers in Canada, and you better beware. Approximately 65% to 70% of the individuals have not experienced significant payment increases because their contracts keeps their payments stable even as interest rates rise. This means they could be paying more without realizing. Let's dive deep into this part. To illustrate, imagine a mortgage payment of $2,200 for a low interest rate. Initially, $900 of the payment might be going towards interest, while $1,300 reduces the principal. As interest rates increase, the interest portion could rise to $2,100, but that total payment remains at $2,200. Consequently, you're only paying $100 applied to the principal. putting borrowers at risk of being underwater on their loans. This situation can extend time to pay off the mortgage from 25 years, and you'll end up paying for 47 years. Banks like TD, CIBC offer negative amortization options, which extend the length of the loans to keep monthly payments stable. However, this is a temporary fix. When these loans are renewed, borrowers face shocking increases. Recent RBC report indicates that some variable rate mortgages holders could see payments rise by as much as 84% by 2026 if your interest rates do not decline. While many economists expect the rates to decrease gradually, it may not be sufficient to alleviate the burden on the borrowers. RBC suggests to achieve more manageable increases, the Bank of Canada would need to lower its prime rate to around 0.25% by July 2026, a scenario deemed likely, and it's not going to happen. As we approach a critical junction, RBC estimates that the approximate 186 billion in mortgages will be up for renewal in 2024, with the figure rising to 315 billion the following year. This represents a substantial amount of mortgage debt taken on historically. Low interest rates often individuals who may not have been able to enter the housing market otherwise. Perception of home ownership as a social norm has intensified, leading many to believe that owning a home is essential. Ultimately, what does this mean for you? Whether you're a homeowner, a potential buyer, or simply keeping an eye on the economy, it's vital to stay informed and be prepared. View your mortgage terms, plan for potential rate increases, and keep updated on economic trends. There are several key factors driving the Canadian banks to set aside more money for bad loans, and I'm going to tell you them right now. Rising interest rates. Interest rates have increased rapidly, significantly, in a way that's unprecedented in Canada's history. This sudden rise creates a higher potential for financial difficulties among borrowers. Upcoming mortgage renewals. Over three-quarters of all mortgages in Canada are due on renewal between now and end of 2026. This concentration of renewals in a short period could lead to payment shocks for many homeowners. Low interest mortgages coming due. Many Canadians look out large mortgages during the period of historically low interest rates 2019 and 2022. As these mortgages come up for renewal much higher rates, there's a risk that some borrowers may struggle with increased payments. The variable rate mortgage with fixed payments. A significant number of variable rate mortgages holders, from 65 to 70%, have not seen increases in their monthly payments despite the rising interest rates. This means they may be paying mostly interest and little principal, but potentially leading to a future financial stress. Potentially for negative amortization, some mortgage products allow for negative amortization, where the loan term is extended to keep payments stable. This could lead to a shock when mortgages are renewed and payments suddenly increase. A large volume of mortgage debt. RBC estimates that 186 billion worth of mortgages up for renewal in 2024 and 315 billion in 2025. This represents a substantial amount of debt that could be risked if economic conditions worsen. Increased home ownership. More Canadians have become homeowners in recent years, stretching their finances to do so. This increased exposure to the housing market amplifies the potential impact of any mortgage related to issues. These factors combined create a scenario where banks are anticipating a higher risk for loan defaults. prompting them to set aside larger reserves to cover potential losses. If you found this video helpful, please like and share and subscribe to our channel for more insights. Don't forget to hit the notification bell to stay informed. Together we can navigate these challenging times.